Good morning and happy Sunday. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, September 22nd, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about the latest financial market conditions. Specifically, we're looking at when to be on offense and seeking opportunities, and also when to be playing defense and protecting our capital. What makes Asbury Research different is we're not trying to predict what the Fed might do, predict how the presidential election might affect markets, or forecast when the S&P 500 or where the S&P 500 is going to be at the end of the year. Those are all unknowns. Nobody knows any of this stuff ahead of time, and nobody especially doesn't know how any of these events might affect financial market direction. We just follow the money because the money never lies. The movement of money is what really drives prices and is the most sensitive indication of the changes in market opinion that ultimately change the market's direction. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individual and professional investors since 2005. To get more information about us, visit asburyresearch.com, which you can see right here on the screen, and you click the Contact tab, which is right here underneath About. You hover your mouse on About, go down to Contact. Or you could just click the link down underneath in the description of this video. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of fast announcements. First of all, we'd like to thank you for listening and subscribing to our Following the Money podcasts. Thanks to you, Following the Money has grown from zero to having thousands of subscribers in a relatively short period of time. To show our appreciation and to gauge the interest in our research through this podcast, we'd like to offer Following the Money listeners 10% off on a limited number of our premium 3 and 12-month research subscriptions. This will be through the end of the month only, which is about a week from now on Monday, September 30th. The special sale is for Following the Money subscribers only and will not be publicly announced anywhere else except for the Following the Money podcast. The subscription includes all of our models and corresponding research, a one-time, one-on-one instructional Zoom meeting with us to just kind of find out how you're investing and how you can overlay our models and tools to help do that better. And we also have a monthly live teach-in via Zoom that shows how to best utilize our models within your own portfolio. If you're interested in doing this, again, go to the Contact tab here, and in the text box that's within the Contact tab, all you need to do is type Follow the Money special offer, and we will send you an email that will give you all the details, a lot of links to click, and also 2 links to click if you'd like to sign up for either the 3 or the 12-month subscription. Finally, my son Jack and I will be presenting our research and data-driven models at the NASDAQ Investors Conference this upcoming Thursday, September 26th at noon, New York time. The topic is using markets and data to handicap the Fed and handicap the election. You can sign up for our presentation, which is next Thursday, and all the other presentations that are effectively going to be going on throughout the week by going to metastock.com and signing up there. Again, this is a free event. Now let's follow the money by identifying our key areas of focus as we look further into the fall and towards the presidential election, which is going to be in early November. The first thing that we want to look at today is tactical direction. So we're going to go here to the Research Center and we're going to look at the Asbury 6, which is one of 2 tactical models that we have to tell us what the internal strength or weakness is in the market. So here's our Asbury 6 here. This is updated through Friday. And you can see 5 of the 6 constituent metrics are all green. Green is positive. The indicator itself has been positive since September the 12th, as we can see up here, and the S&P is the S&P is up 1.4% since then. All of these numbers here are the dates that each of these constituents had turned to positive, and you can see most of them turned, well, 3 of them turned on the 12th, and then 2 more of them turned positive on the 19th, which is at the end of last week. So a relatively new signal per se. According to a little bit about the Asbury 6 first. For those who aren't familiar with us, the Asbury 6 is our daily updated risk management model that looks beyond the day-to-day noise and volatility of the stock market to determine its actual health, its under-the-hood health. We view the A6 as a lie detector test for the market that helps investors identify real, sustainable market advances or market declines from computer-driven traps for investors, which I think we're seeing more and more these days, where you wake up in the morning and the S&P is down 50 and it's up 50 by the afternoon. According to our historical backtesting of the A6 has kept right up with the S&P 500 since 2017 at a 12.5% rise annualized. Again, this is going back towards the latter part of 2017, so about 7 years. But the difference is the maximum drawdown in the A6 has only been 13.6%. The max drawdown in the S&P 500 has been 33.9%. So significantly less risk. Lower drawdowns mean that you can recapture your losses anytime the market moves against you a lot faster, so you could start to make money again. Make sure you read the disclosures at the end of this video that pertain to hypothetical backtesting. Past performance does not equal future performance. The next thing we want to look at is sector rotation according to our CEF model. So we're going to change views here, and we're going to take a look at, these are called rainbow charts, and these are the accompanying charts that go with the CEF model. The CEF model, if you're not familiar, is a completely data-driven sector rotation model. CEF is an acronym for sector ETF asset flows. The CEF model was created to quantitatively identify long overweight opportunities in U.S. market sectors by following the money as it moves around the 11 sectors of the S&P 500. The CEF model is always fully invested in the market. It's always invested in the top 3 according to our ranking system that goes along with the CEF model. We look at it as a dynamic alternative to the traditional buy and hold portion of an investor's portfolio. The difference is, instead of buying the S&P 500 and praying that it continues to go up, we're following the money as it moves around the various sectors, and we're invested in those sectors that are getting the most attention in terms of asset flows, and we do this in multiple time frames. You could learn more about all of our models, including charts and backtested performance tables, by visiting asburyresearch.com and going to the Models tab. So let's take a look at real estate. Heading into next week, one of our 3 top-ranked sectors, according to CEF, is real estate. The ticker is XLRE. The upper panel of this chart, the rainbow chart, shows that real estate moved into favored status according to the CEF model on July the 23rd. Let's have a look at this. So there are 3 different rankings for any of the 11 sectors in the CEF model. These are updated once a week on the weekend, showing the previous week's data. So what you can see here is that real estate moved into favored ranking. You can see why they call them rainbow charts with the different colors. But on July the 23rd, we moved into a favored ranking according to CEF. We tested that ranking on August the 5th. We tested it again earlier this week, but we're still favored. Look what has happened down here. The chart down on the bottom is a relative performance chart of XLRE versus SPY, which is the ETF for the S&P 500. You can see since it has been in a favored status, XLRE has outperformed the S&P by 14%. This is how the model works. It determines where the money's going, and it follows that money. The CEF model's 2 additional favorite sectors this week are available to our premium subscribers by logging into the Research Center. Another feature of the Research Center are our ETF trading ideas. We'll just back up here a second, and we'll go back to the Research Center. And you can see that all of our models are up here up top. Our Asbury ETF trade ideas are are trades rather than investments. These are typically shorter term trades. There are 4 criteria for these. Number 1 is a positive trend. Number 2 is relative outperformance versus the S&P. Number 3 is positive asset flows. And number 4 is an attractive risk to reward ratio. Over the past 15 months, we've published 67 of these. 67% of them have been profitable, and the average profitable trade has been 2.1% larger than the average losing trade. Keeping the numbers right on how many times you're right and how much bigger are your winners than your losers are really critically important to trading. We currently have 5 open ETF trade ideas. One of them is the Spider S&P Telecom ETF. It's XTL. Let's have a look at that now. So here's XTL up top. This is daily. You can see it. These are our working charts. So there's a lot of lines drawn in here. The orange line here is the 200-day moving average. The blue is the 50-day moving average. Down here is the relative performance chart versus SPY. So as this line down here in the lower panel goes down, XTL is underperforming the market. As it turns higher, it's outperforming. So we purchased XTL on August the 20th. Let's get a little closer here. We purchased this on October 20th as it was testing this resistance level that goes all the way back here to the latter part of 2021. So we bought it here in white. This is the white arrow, and here is the relative outperformance since then. Since then, it has outperformed the S&P by 3%. And it's risen outright by 5%. From here up to the close at the end of last week is 5%. Here's what we're looking for going forward. The next big overhead resistance level is these highs that we made here at the latter part of 2021 at 104. We're currently at, let's call it 99. We're at 98.96. We will continue to ratchet up the stop on this trade as it continues to hopefully go higher. Asset flows are still very good. The last thing that we want to look at here is taken from our Keys to This Week report. So we're going to change views one more time. We're going to go back here to the Research Center. Keys to This Week is written once a week. This particular one was written on Friday, September 20th, so it's very recent. And what we're going to do here is scroll down to one particular chart that we think is really important. This is the NASDAQ composite index. There's the composite index, and then there's NDX, which is the 100. This is the broader index. Technology typically leads the market higher and lower. The reason we're looking at this today is we've had this sideways coiling going on in comp since July. You can see July 11th top here. We dropped down to test the 200-day moving average in orange on August the 5th. August the 5th was a big low for all the indexes. And then we had all this coiling. Coiling indicates indecision in the marketplace. We broke out of the coiling on September the 19th. What does that mean? It means that traders, investors had enough courage, had enough conviction to buy this and push it outside of the safety zone that's indicated in blue. Indicates the larger uptrend, which started back in 2023, is starting to re-engage. How do we know if we're wrong? If it goes back down through the apex of this triangle at 17,395, that tells us the market changed its mind, and it would suggest that this top that we made in July is something that's going to become more meaningful. Right now, as long as we can hold where we are right now, roughly 17,500 area, it targets a move to 20,250. So we're looking at this chart as kind of a barometer of what to expect from the markets in the upcoming weeks and maybe into the holiday season. This is a really key component of what we're looking at. Finally, let's just take a quick look at next week's economic calendar. Tuesday, 9/24, we have the S&P Case-Shiller Home Price Index for July. Wednesday, 9/25, is new home sales. Thursday, 9/26, it's pending home sales, both for August. Why do we care about this so much? Why are we talking about home sales? One of those open trades that we have on our ETF trade idea is relatively new idea is an XHB. That is the housing ETF. So we're already involved in this trade, and we're going to be watching these numbers really closely next week to see if they enhance the trade or if they are a detriment. Finally, Friday PCE, it's personal consumption expenditures. It's the Fed's favorite index for gauging inflation. So we're going to see that for August on Friday morning at 7:30. So there you go. Kind of a long one today. That wraps up another Asbury Research Following the Money podcast for this week. Our next Following the Money is tentatively scheduled 2 Sundays from now on October the 6th. If you like our approach to investing, we can help you with either data-driven research or with asset management that implements my 40 plus years of experience in the financial markets and our own data-driven models. Everything that we do is data-driven here. We're not trying to forecast. We're trying to read the data and watch where the money's going. You can request more information again by going to asburyresearch.com right here, going to About and clicking the Contact tab. Hope to see you here again soon. Thanks for watching our Following the Money and helping it grow. And please don't forget to like and subscribe. Have a great Sunday.